Sticking with this morning's CPI report, let's welcome in Nick Brooks, ICG Head of Economics and Investment Research, for his reaction to the numbers. And Nick, let me just get your thoughts, your frontline thoughts on those headline numbers here, especially that core reading, which just shot up, excluding food and energy.
Yeah, I think that's the key problem. I mean, the headline number has been sort of gradually coming down since June, but the real focus is on the core inflation, which of course is what the Fed really cares about, and that just keeps going up. And as you were highlighting, food inflation is very high. Shelter inflation has also been a key driver of the rate. Healthcare costs, and pretty much across the board in services. So the problem with this type of number is, I don't think the Fed wants to continue raising rates. I think the Fed recognizes quite clearly that the economy is probably going into a slowdown over the next couple of quarters. But as long as those core inflation rates remain so high, they need to keep raising rates to keep it under control. So I think, bottom line is, and the market seems to think, we're going to get 75 basis points from the Fed in November. And now markets are starting to price potentially another 75 in December. Yeah. So not a good place to be.
Yes, I even saw a 100 basis point raise in November being priced as, I think the probability was 2% max, but just goes to show you the extent to which the Fed, which has really been consistent on its messaging. I was going through the FOMC minutes that were released yesterday. No big surprises, as CPI, of course, being the bigger report here. But we've seen central bank action out of the Bank of England, the Bank of Japan just get completely reversed. I mean, you look at the debt of the UK or the currency of Japan trading like emerging markets here. What do you make of the central banker reaction? How painted into a corner are they?
I think they're all painted into quite a severe corner. And I'm based here in the UK, and I won't start talking too much about the UK, but they're in a very, very tight spot. And I think the problem is, central banks haven't faced anything like this since the late 70s, early 80s, where you've got extreme inflation, and it's broad based. And the central banks recognize that growth is coming down. And if it wasn't for these inflation rates, they'd probably be cutting rates. But bottom line is they're worried that inflationary expectations could get out of control, and we'll get the feared wage price spiral that becomes self-fulfilling. So they have to talk tough, they have to act tough until inflation rates start coming down, even if it means recession.
Well, and we've gotten commentary from CEOs who may or may not be talking their books, but Jamie Dimon sticks out in particular, especially ahead of earnings, which we expect imminently this week, tomorrow morning. And he's talking about another 20% decline in the S&P 500, already on its way there over the last couple days. Just wondering what you see in terms of the market setup, any levels you're looking at. What are you looking for in the eventual rebound when we find a bottom finally?
Yeah, I think there are a couple of things. My own view would be that, a lot of the rate increases are in the market. So if you look at swap rates, if you look at forward rates, I think a lot of the central bank hikes that are coming are actually in the market. I think where perhaps the market has not yet priced appropriately is the risk of quite a severe earnings decline as we move into potential recession. So I think the PEs need to come down further, and the earnings are also likely to come down further. So I think there is certainly likely to be more downside on equity markets. The other point, though, I'd make is I think very similar to what we saw during the worst of the COVID pandemic. I think it will be very sector focused. I think there are going to be some sectors that are clearly going to be hit much harder than others in this type of environment. But there will also be some sectors that will perhaps be less affected. So I think one does have to take a more nuanced approach if one has a medium-term view on and a medium-term investment horizon.
Investors need the nuanced view because the Fed is not playing the nuanced game. Well said here. Nick Brooks, ICG, Head of Economic and Investment Research. Thank you for your time today.